Hello, everyone. We are together again in the second part of our chapter on inflation, chapter 34. In this part of the lecture, we are going to talk about the quantity theory of money and the Phillips curve relationship. Right now, when we talk about inflation and the inflation process, actually the expectations on inflation play a key role in the inflationary process right? What do we mean by that? When expectations of inflation are high, of course, from the point of view of the public, people raise their wages and the prices, further leading to inflation. So expectations can become self-fulfilling prophecies, meaning that you expect something and what you expect actually happens. That's what we call self-fulfilling prophecies. So when you expect inflation to be high, you raise the wages and the prices, which cause inflation. Therefore, expectations become self-fulfilling. Now we can examine the different ways by which the expectations are formed in the public, in an economy. One is the rational expectations. Now, what do we imply by rational expectations? Those are the expectations that the economists' models predict. Now, what do we mean by that? When people use the available information to its highest efficiency, they will be able to take in the information and form an expectation about certain variables, including the inflation in an economy. Okay, so rational expectations mean that people act rationally and they take in all the information available to them and they form an expectation about inflation based on this information, including the model that the economists build on inflation. For example, in this case, let's say that inflation was 2% last year, and it is 4% this year. But economists build a model for inflation and they predict that inflation will be 0% next year. Therefore, you take in this information and expect that inflation will be 0% next year. So you rationally expect that inflation will be 0% next year. So what did you do here? You took in the information created by the economists, and you formed your expectations based on that. There's another way by which expectations can be formed, and that's what we call adaptive expectations. Let's say that inflation was 2% last year, and I'm sorry, let's say the inflation was 4% last year and it is 2% this year. So you will expect the inflation rate to be about 3% next year. Some average of what you saw last year and what you see this year. Okay, so this is what we call adaptive expectations. You base your expectations on past experiences. Another way by which the expectations are formed is called extrapolative expectations. The expectations are formed based on a trend that you experience or a trend that you see. For example, last year inflation was 2%, this year inflation is 4%, and you will expect the inflation to be 6% next year. Okay, so I mean, depending on how expectations are formed, the inflationary expectations will be different. But of course, certain, under certain cases, we expect a certain, or we attribute a certain form of expectation building. In most, models, you might, use rational expectations. In other models, you might use adaptive expectations. In other models, you might use extrapolative expectations, depending on what you wanted to do. There are two key measures that policymakers look at to determine inflation, are the changes in productivity and changes in wages. Okay, so policymakers actually look at those two measures, the changes in productivity and the changes in wages, to determine what inflation is going to be, more or less. Together, these measures determine whether or not the short-run aggregate supply curve will be shifting up or not. As we studied in previous chapters, as you would remember, changes in the wages or an increase in the wages will shift the short-run aggregate supply curve upwards. Okay, so this shift in the short-run aggregate supply curve here, this shift from SA0 to SA1, right? This shift is due to the increase in the nominal wages, right? As you see, the nominal wages go up and we move up along the aggregate demand curve up to a higher price level. On the other hand, an increase in the productivity, as we know, will lower production costs. Therefore, the short-run aggregate supply curve will be shifting down. With the lowering of the unit costs, there will be a lower price level. Okay, so what we do is we look at the net effect of these two. At any given point in time, there might be rises in the wages and there might be rises in productivity. So what inflation is going to be is determined by the difference between those two measures. For example, if wages rise by more than the rise in productivity, you will expect inflation. On the other hand, if you expect productivity to rise at a higher rate than the nominal wages, you will expect a fall in the prices or deflation or negative inflation. Okay. So then policymakers, to assess what inflation rate is going to be more or less, right, approximately, they look at the percentage change in the nominal wages and the percentage change in productivity. And the difference between those two is going to give the policymaker some idea of the direction of the inflation, whether it is a positive inflation and at what rate, or whether it is a negative inflation or deflation and at what rate. All right, now from here on, let's talk about the quantity theory of money and its implications with respect to inflation. Now, the quantity theory of money, it was popularized back in the 1950s and 60s. It emphasizes the connection between money and inflation, and the quantity theory of money can be summarized in one sentence, which says, inflation is always and everywhere a monetary phenomenon. Now, when we talk about the quantity theory of money, we actually talk about an equation of exchange, which is the quantity of money multiplied with the velocity of money must be equal to the price level times the real output, which is the nominal value of output. So the quantity of money supplied times the velocity must be equal to the nominal GDP, or the nominal value of output and income in the economy at any given point in time. Now, we know what the quantity of money is, that is the money supply. We know the price level, we know the real output. So what is the velocity of money? Velocity of money is how many times a dollar or a Turkish lira exchanges hands. That's to say, it is the number of times per year on average a dollar or a Turkish lira gets spent on goods and services. Basically, it is how many times one Turkish lira bill exchanges hands during a year. And it is given by, of course, directly from the equation of exchange. It is given by the nominal GDP, P times Q, divided by the money supply. Now, there are certain assumptions that we make in building the quantity theory of money. The first one is that velocity is constant. Velocity is constant at any given point in time. We have a given ratio, nominal GDP over money supply, even though they might be changing. So it says that they are changing at the same rate. The second assumption is that the real output is independent of money supply. So actually, this quantity theory of money pertains, I would say, to the long-run equilibrium of the economy, where we produce the potential output independent of the money supply. So the real output here, or real income, is independent of the money supply, meaning it is determined by forces outside those in the quantity theory. For example, it is determined by the capital stock in the economy, it is determined by the technology level, it is determined by the labor force amount, it is determined by the institutional structure of the economy, right? All these factors other than the demand factors. Another important assumption is that the causation goes from money to prices. And the quantity theory says that the price level varies in response to changes in the quantity theory of money. So, for example, if the nominal money supply goes up by 10%, it will be followed with an increase in the price level by 10% exactly. And also, if money supply goes down by 5%, it will be followed by a fall in the prices by 5%. So the causation goes from money supply to prices. The changes in the money supply determine the rate of change in the prices. So 10% change in the money supply leads to a 10% change in the price level, or 10% inflation. Right, so I mean, this is really straightforward then, right? Velocity is constant, Q is constant, therefore any change in the price level, therefore any change in any inflation will be due to a change in the money supply. But of course, since then, we have many other different theories relating to inflation. For example, we have seen that velocity is not necessarily constant. And since 2008, particularly in the developed economies, velocity has dropped enormously. Also, the link between the money supply changes and the inflation might be broken, in the sense that, particularly since the financial crisis, although there has been a contraction in the money supply all around the world, really, there has not been any decline in the inflation rate. Okay, so even though we have seen a substantial contraction in the money supply in the world, inflation rate has not fallen, concurrently. It hasn't fallen following the contraction in the money supply. But of course, even though it is no longer directly applicable, or it is no longer, directly related to the real world policy, its general point still remains relevant when we think about the long-term equilibrium in the economy. Again, as we said, the quantity theory of money takes the real GDP independent of what happens to money supply. So it means that the quantity theory of money views belong to the long-term equilibrium of the economy. So in the long term, they might still be valid. These points might still be valid. All right, now another important issue that we need to touch upon is the Phillips curve relationship in inflation and unemployment. Since the mid 1950s, I would say, inflation has been discussed in relation to unemployment with the help of what we call the Phillips curve relationship, or the Phillips curve. Right, the short-run Phillips curve actually is a downward sloping curve showing the relationship between inflation rate and the unemployment rate when expectations of inflation are held constant. Now, the traditional Phillips curve relationship, where the expectations on inflation are constant, is a downward sloping curve representing the trade-off between unemployment and inflation. What do we mean by the trade-off? If you want lower inflation in your economy, then you accept high unemployment. On the other hand, if you want lower unemployment, you need to live with high inflation. Okay, so actually, when the Phillips curve relationship was first found, or when it was first established, that was that direct trade-off, or it represented this direct trade-off between inflation and unemployment. But when we come to the 1970s, this direct trade-off between unemployment and inflation has broken down, right? This relationship has broken down because inflation rate has started to increase independent of what happens to unemployment and what happens to wages in the labor market. Okay, so basically the short-run traditional Phillips curve relationship tells us something about the what happens in the labor market in terms of unemployment and wages and the inflation rate, because as you might imagine, cost of labor is the is an important component in the prices of goods. Okay, they are almost completely reflected in the prices of goods. So what happens to inflation is directly related to what happens to wages, and of course what happens to employment and unemployment. But when we come to 1970s, this link has been broken. We no longer see this trade-off. Actually, we see a combination of high and accelerating inflation together with high unemployment. So we no longer have high unemployment and low inflation, or low inflation and high unemployment. Okay, so that's no longer the case. So what we end up with in the 1970s is stagflation, stagnation together with inflation. Stagnation, of course, refers to a recession in the economy with high unemployment, and of course, inflation, as its name suggests, high and accelerating inflation existing together with high unemployment. So basically what happened in the 1970s is the Phillips relationship has broken down because prices started to increase, or inflation started to accelerate independent of what happened in the labor market. And from that, you can imagine that prices of other inputs other than labor have also started increasing, which were reflected in the prices of goods, such as price of oil, price of energy. Okay, so in the 1970s, what happened was there was this OPEC oil crisis in the developed economies, which of course spilled over to developing economies like ours. So there was a oil crisis all over the world, which raised the oil prices. Right, OPEC they cut down on supply of oil at that time. So there was this shortage of oil, therefore, shortage of gas, which led to an increase in the price of gas or price of oil, which of course would be reflected into the prices of goods and services. So independent of what happened in the labor market, but independent of what happened to the wages, prices started to rise. Okay, so that was something that was not considered up until the 1970s. That was a new phenomenon. So it led to the idea of the expectations on inflation also having an effect on the Phillips curve relationship. Okay, so now along the short-run Phillips curve relationship, as I said, the expectations of inflation are fixed, they are constant. On the other hand, now we talk about an expectations adapted Phillips curve relationship, or what we also can call the long-run Phillips curve relationships, where the expectations of inflation are equal to actual inflation. So you embed the inflationary expectations into the Phillips curve relationship. And it will be a vertical curve at the unemployment rate consistent with the economy's potential output, or what we know to be as the natural unemployment rate. So that's what we see here. As you see, the traditional short-run Phillips curve relationship is a downward sloping curve showing the negative relationship between inflation and unemployment rate. As you see, if you are okay with high unemployment rate, then you expect or you have low inflation, or if you live with high inflation rates, then you can have low unemployment rate. On the other hand, the long run Phillips curve relationship is a vertical line at the natural unemployment rate and at the potential output level. All right, so how does it work really? How do we, go from the short run relationship to the long run relationship? Now, in the short run, as we have seen in chapter 26, for example, the economy can expand beyond the natural rate of unemployment by accepting higher inflation, which we called the overutilization of resources leading to the inflationary gap. Remember, while we were at the potential output of the economy, and while we are at the long run equilibrium of the economy, the government can increase aggregate demand, let's say through fiscal expansion or through monetary expansion. And as you remember, that would lead to the economy to move beyond the potential level of output with overutilization of resources. And this overutilization of resources meant inflationary gap, as you remember. And this is represented as a movement from point A on PC0 to point B. Okay, so as you see here, the government is trying to stimulate income and output and over the potential. Let's say here the 5.5 is the natural unemployment rate in this economy, and I'm going to reduce the unemployment rate below the potential to 4.5 by stimulating the economy above the potential output level. Therefore, reduce the unemployment rate. Of course, with that, I'm going to be willing to live with a higher inflation rate, let's say 4%. But of course, over time, the high inflation, right, as you go from 0 to 4%, this higher inflation is going to build into expectations, into public's expectations, and there will be further pressure to raise wages and other prices in the economy beyond 4%, let's say by 6%. Okay, so as the inflation increases, as you see from 0 to 4%, there will be further expectations for the rise in the inflation to continue, and therefore this will be reflected into wage contracts and other price contracts. So with that, as there are expectations for inflation to increase, now, as you can imagine, inflationary expectations are no longer constant, they are increasing. So they will take us to a higher Phillips curve relationship. As you see, we move from PC0 in the short run relationship to PC1. Okay, so the inflationary expectations are no longer constant. We have higher inflationary expectations. So we move up, to a higher Phillips curve function. So as you see now, with higher inflationary expectations, even though the unemployment is still at 5.5, the inflation is 6%. Okay, so with higher expectations on inflation, 5.5 unemployment rate will be sustained now at 6% inflation, not at 0% inflation as it used to be. So what is the idea here? The idea is that anytime unemployment is lower than the natural rate of unemployment, as we see here, moving from 5.5 to 4.5, inflation and expectations of inflation will be rising. This shifts the short-run Phillips curve up until output is no longer above potential and unemployment is no longer below the natural rate. So as economy is pushed towards, as economy is pushed above the potential, it will cause inflation to accelerate. Okay, so as long as inflation stays above what is consistent with the potential output, people will start inflation to persist. People will start to expect inflation to rise further in the future. Okay, so then you will be, moving on to higher and higher Phillips curves. Therefore, you will be experiencing higher inflation consistent with the potential output and the natural unemployment rate. All right, so that is the description of the short-run Phillips curve relationship and the moving on to a long-run Phillips curve relationship. Okay, so in the long run, you can say that expectations on inflation are not constant. Okay, so they can change over time, leading the short-run Phillips curve to shift up continually. Of course, as long as the government tries to stimulate the economy below the natural unemployment rate. I mean, if the government does not do that, you will always stay on the same Phillips curve relationship. Of course, there will be no new expectations on inflation to be created. But of course, as the government meddles into the economy and tries to stimulate the economy above the potential, stimulate the unemployment rate below the natural unemployment rate, it will create these inflationary expectations, pushing the Phillips curve upwards. Therefore, the inflation rate that is consistent with the natural unemployment rate will always be rising. So what also does it mean? Now, it doesn't talk about this in the book, but also what does it mean? It means that the natural unemployment rate is always pushed out. Okay, so as you see here, the natural unemployment rate was 5.5. Now, under the new short-run Phillips curve relationship, actually, here, as you see, the natural unemployment rate is, let's say, 7%, okay? Consistent with zero inflation. Okay, so that's also something that we need to be aware of. That is the point of stagflation. Okay, so you have inflation and you have a contraction in the potential output and a rise in the natural unemployment rate. All right, so I mean, I'm not going to talk about this. This is too much detail for you at this point. But I would want you to be, aware of what the short-run Phillips curve relation represents and what the long-run Phillips curve relation represents. Okay, so in terms of the trade-off between unemployment and inflation in an economy. All right, so that's going to conclude our chapter on inflation. Chapter 34. So let me stop here. We will provide you with of course, new problem set this week. You will be able to study those chapters 33 and 34 together. And next week, I will be together with you with a new topic where we are going to discuss the comparative advantage topic, right? We are going to move to a different topic where we are going to discuss international trade. And we will go back to the comparative advantage issue, okay? And we are also, let me check, we are also going to talk about the determination of exchange rates, okay? So next week, we are going to move on to international trade, and that's where we are going to stay in the remainder of the semester, because in the last week, we are going to talk about the international financial markets and the balance of payments table for a country. We are going to talk about the Turkish balance of payments table, basically. Okay. All right. So have a nice week, everybody, and I will talk to you again later next week. Bye-bye.